Welcome to the Daybreak Asia podcast. I'm Charlie Pelletin for Doug Krisner this week. Global markets are entering a seasonally strong period. For more on the markets, we spoke with Alicia Garcia Herrero, chief APAC economist at Natixis CIB, and she spoke with Bloomberg's Sherry An and Heidi Stroud-Watts.
It's interesting you talk about the lack of restraint as being something that, either in response or through a broader global trend is going to be pervasive next year. What does that mean for the global economic cycle, do you think, over not just next year, but perhaps the next few years?
Well, we're going to have fiscal problems. We don't know where they're going to start. I think Trump will get, what is delivered when you do fiscal stimulus beyond where we are already in the U.S., which is a strong dollar, not what Trump wants, but that's what he will get and what he's getting. I think for the U.S. to have financing problems is too early. I think, the U.S. will attract a lot of capital because he will cut taxes, and that will help. But in the long run, of course, this is problematic. I think the first ones to feel the pinch of this lack of fiscal restraint will be emerging economies, frontier markets. I think that everybody has been riding on a Fed that would finally ease aggressively, but the Fed might not ease aggressively anymore. So, these countries are already strangled somehow with hoping for cuts. And some are even cutting because they can't wait, but others aren't able to cut because the currencies are weakening. We see a lot of weakening of EM currencies at the moment. So those will be the first to see what it means not to have done fiscal restraint on time. And I'm expecting a lot of these EM and frontier markets to suffer indeed.
And it's not just emerging market currencies weakening, right? I mean, we're coming from these comments from the finance minister in France, but the euro has just capped the worst month in over a year already. And we saw the euro take another dip lower coming from that French political volatility. Where does the U.S. dollar go from here when you also have the pressure on the other side of the trade with a weakening potentially European economy and more ECB rate cuts to come?
Yeah, well, we had some comments from the European Central Bank, from Isabel Schnabel, basically saying that, the ECB might not be able to cut as much as for this reason, because they're seeing that first, the euro is already very weak. We have these issues with the French budget. We have elections in Germany. So, we might not be seeing as many cuts as expected, even for the European Central Bank, for the reason you mentioned. But I think, on the other hand, the euro is weakening also because everybody is counting by now on tariffs. If Trump put tariffs on Mexico and Canada, basically, with a free trade agreement, just imagine Europe or, anywhere else. So I think currencies are weakening in the light of the need to be weaker to withstand tariffs from Trump. So it's a mixture of, I think, political uncertainty in France and Germany and the need for a weaker currency in the light of Trump's tariffs. That's what it is.
When it comes about the health of the U.S. economy, what sort of indications are you getting from the holiday shopping season, especially when it comes to, of course, the American consumer that's so important for the broader economy?
Well, we need to wait. I think the key data is yet to come. I really want to see this employment data after the distorted data because of the storms. Because the consumption data is kind of hard to read now, I have to say. I mean, everywhere in the world, we had very positive consumption data in October for China, and nobody understands how that could happen because, the mood is so negative. And I think in the U.S. it's a little bit like that as well. So I think we need to wait for employment data to have because we missed a month. We couldn't read that month to really know what the Fed might be doing. But the Fed knows that it will need to deal with with much more expensive imports from, by now, literally all over the world. Mexico is the largest import market for the U.S., and we are going to have tariffs. So the Fed will have to count on all of this, no matter the consumption data or even the employment data, because their inflation outlook will look worse. That's clear.
So we've been kind of trying to be patient when it comes to how these stimulus measures have started to kind of percolate through, particularly when it comes to some of these private companies, right? How sustainable do you think this sort of nascent rebound will be? And how does kind of the fiscal side potentially change if Beijing is looking at, needing kind of firepower for the next 4 years, depending on what President Trump does?
So I'll be blunt and brief. We're not expecting a rebound at Natixis. And why? Because the stimulus is not a stimulus. It's a restructuring package, which is very welcome, by the way, because China has all of this hidden debt. Local governments are excessively indebted. This percolates into the economy, and any supplier from local governments is still waiting to be paid. So, all of this is welcome, but it's not really a stimulus package in the way we understand it, comparing it to 2008 in any form. So, we are going to have lower growth in 2025, maybe mitigating the deceleration, though, thanks to the package. So we're around probably 4.5 in 2025. So no real recovery, unless, and by the way, and this is still not counting on massive tariffs. So basically, if Trump behaves nicely, I wouldn't say a trade deal, but at least tariffs that are not too different for China, as we're seeing so far, given his announcement on China versus Mexico and Canada, we would see that type of growth. If, however, the party feels that they need more and they come with a big stimulus, this time around consumption-based stimulus, then that would be a different ballgame. But frankly, I think they would be very hesitant because the actual official debt in China will go up by 8 percentage points of GDP, only because of this 10 trillion RMB package only. So, the official debt is really going to increase. And I think they will be very careful to have a big bump in public debt with an additional consumption-based stimulus.
So what do you see as being, I guess, the sort of flow-on effects when it comes to China's trading partners, right? We're already seeing this sort of flurry of front-loading effects, and we're seeing that from some companies that trade with China as well. Do you see that sort of level of, I guess, the green shoots that we have at the moment being sustained on that front as well?
So there's two types of green shoots. One is on the consumption side. In October, we had good numbers, but it was mostly the Golden Week. And the first 10 days of October were, stock market flurry, and everybody was, thinking it would last. It didn't last. So I think I'm expecting worse consumption numbers in November. PMI, I think, is very much driven by export orders, and these are coming because of tariffs, and therefore they're not sustainable. So I actually think China's growth next year will be hurt mostly because of a smaller contribution of external demand. And this is tariff related, not only the US. If you look at the number of countries so far, even Russia, latest news, the number of tariffs China will be confronted with next year will be humongous.
What will that mean for trading partners across Asia? Already last week, we're surprised to see the Bank of Korea actually cut rates. That was unexpected. We saw the RBNZ also cutting rates. It seems that the economic outlook across Asia might not look as encouraging in 2025.
Yes, exactly. And I think there is an important reason for this. We think substitution. Yeah, we think, okay, if China is hit by tariffs, somebody else will export to the US. But South Korea was already banking on that. This was the IRA. South Korea had kind of a special access to the US market, which China didn't, through basically access to subsidies. And that is very likely to be stopped by Trump. So the gain that we could have seen for South Korea is actually not going to be there. And then in general, the whole region is decelerating. India is decelerating. China, as I said, even with this stimulus, so-called stimulus, will be decelerating next year. So, it's just only natural to and by the way, the U.S. economy still, I mean, no matter what Trump might do, we still hold the view that there will be a deceleration. Europe is not doing well. I mean, why would you have an exuberant Asia? I mean, I can understand the feeling of many of the central banks that they want to cut. It's logical. The problem is some might not be able to cut because their currencies may be too weak. And that is when we hit the wall for some EM Asia.
Yeah, I hear a lot of caution coming from you, Alicia. Good to have you with us. Alicia Garcia Herrero, Chief Asia Pacific Economist at Natixis CIB.
Welcome back to the Daybreak Asia podcast. I'm Charlie Pellet. Doug Krisner's got the week off. As geopolitical concerns linger around China's economy, market participants are exploring opportunities in other Asian markets. We heard earlier from Vikas Pershad, Asian Equities Portfolio Manager at M&G Investments, and he spoke with Bloomberg's Sherry An and Heidi Stroud-Watts.
So, as we sort of start to get into the period where we round out the year, I suppose it's worth reflecting on some of the big market trends. And two of them, of course, have been the market darlings of Japan and India, and then also the undervaluing, I suppose, the lack of interest and appetite for China. How do you think these themes play into the next year? Do you think investors should sort of brace but hold their positions if there is that rotation?
Three very different markets. My view is that investors should be braced for outflows from these markets into the U.S. When you look at the strength there, we just had a great month in the U.S. We should be braced for that, but investors should be doing the opposite. As we head into 2025, the equity growth stories for the next year and beyond in all three markets remain very strong. In Japan, this is a market that can compound earnings at 10%, 8 to 10% over the next few years. Buybacks, dividends will help that. China, the equity market capitalization contribution to the world is dwarfed by the GDP contribution to the world. There's a huge dislocation there. People are wary of the tariffs that are coming, but these are not the same Chinese companies that were around in 2016 and 17 when the first set of tariffs came under Trump 1.0. These companies are smarter, they're leaner, they're better at capital allocation, and we're seeing lots of opportunities there. And India, this might be the longest tail growth story in the world today among major markets. And 6,000 listed companies, $5.5 trillion market cap. If you look at where the GDP is going, I know we had a hiccup in the most recent month, and we can talk about that. But there will be a GDP multiplier here. The economy will continue to grow. This market is also one that should deliver alpha for investors for the long term.
Yeah, and in fact, that's where we're coming to you in India at the moment, right? What sort of conversations are you having with investors right now who, I guess, want to know, as richly valued as this market is, where do you see the expansion of opportunities from here?
Well, Make in India is very real. This is one of my key lessons from this year. It's how real that is, how pervasive that is, and how much support there is from the government. The semiconductor industry is something that I thought would not be taking root in India anytime soon. But you look at the magnitude of the investments by the government, the facilities being set up in Western India and Southern India, that is very real. But if you look lower end from that, the assembly and manufacturing of components, that will shift to India. It already has. The fact that Apple produces the high percentage of phones in India that it does already, that's a signal that things are moving apace. Also related to Make in India, it's not just selling to Indians, but selling abroad and the export opportunity. I'm in India now. I'm headed to Riyadh for the first time later this week. I'm looking forward to that. Most of the companies I speak to these days that are involved in the manufacturing sector bring up Make in India and selling to Indians, but they also bring up the very large opportunities that are resulting from Saudi. That could be a potential manufacturing hub. Companies that are involved in infrastructure are seeing massive demand from the Saudis. I think it was Bloomberg just last month that carried a headline saying that within the next 3 to 4 years, Saudi will be the largest construction site on the planet. So I'm going to go check it out. Based on what I'm hearing from the companies, that's something that's very real. The last thing I'll just add quickly is on luxury spending. When I moved to Asia 20 years ago, the focus was on the bottom of the pyramid. Now, most of the new exciting opportunities we're seeing are at the very top of the pyramid, where the ultra-high spending is on property, on cars, on luxury items. We just had the Bulgari CEO on before me. So that theme is playing out in India. Hospitals also paying for high-end services, high-end surgeries. That's where our focus is.
Because another market darling this year, as Heidi alluded to, has been Japan, of course. And we continue to see this stronger than expected economic numbers. Just now we got capital spending also surprising to the upside. Come 2025, we continue to see BOJ rate hikes. Could this economic momentum and also market momentum be hindered?
Our view is beyond that, longer term. When we look at the corporate governance transformation underway and what that is yielding, and it's across sectors, it's across market caps even now. It started with the largest companies like Hitachi and Sony and the transformations they went through. But we're seeing it pervade throughout the entire listed universe in Japan and in some of the private companies as well. Our view is if we pick the largest white spaces and we back the best management teams, though we're not ignorant of interest rate levels and FX levels, these best companies will treat this as business as usual, and they will figure it out. Also, what is very heartening to us is the level of engagement that we now have with Japanese companies on all of these issues, and including on diversity, on board structure, on disclosures. So Japan is changing, and though we're constructive on Japan for 2025, our excitement goes far beyond that.
We're also keeping a close eye on all of the concerns around the budget negotiations right now happening in France and, of course, the broader euro economy. How exposed are Asian markets to what's happening in Europe?
So this is something I feel like in Asia, perhaps we don't talk about enough on the buy side, perhaps with the sell side also. Companies are quite exposed. And if you look at machine tool companies in Japan, listed machine tool companies in Japan, the leading companies have 30 to 40% exposure to Europe. If you look at some of the auto parts companies in India that are listed, they also have 30, 40% of their revenues coming from Europe. The situation is not great. And it's global. So if we start with the largest manufacturing sector in the world, the auto sector, I opened Bloomberg this morning to see Nissan's CFO has resigned. The Stellantis CEO has resigned. There's pain on the ground in Germany in particular, in the auto manufacturers there, but it goes beyond that as well. So if we start with the largest manufacturing sector in the world in autos, the situation is not good. And that does include CVs. That does include auto parts. It's not just passenger vehicles. And that brings us back to China. The Chinese EVs are benefiting. Clearly, we've seen that supply chain is benefiting. And there's a broader set of benefits accruing to Chinese companies in manufacturing, in the semiconductor supply chain as well. We can talk about that now or perhaps later, but there's a lot to discuss about China as well.
And because we started this conversation and you mentioned how I was practicing my Spanish earlier before we came on the air, I follow LATAM stocks in Latin America very closely, as you know. I know that you don't follow them very closely, but when we talk about China and the broader emerging market scheme, how important will the offshore yuan, for example, be in the anchoring of expectations around emerging markets come 2025, especially when you have another big player with Trump 2.0 coming with really these idiosyncratic news that could come out from that administration?
Well, I'm going to contradict myself briefly and say that we tend not to focus too much on FX levels, but the yen and the yuan and what's going on there, we do pay attention. And the yuan anchoring you're talking about, we'll see the ramifications of that next year. Now on LATAM, it's fascinating to look at time series data of who the largest trading partners are for countries in South America and how that has evolved and shifted away from the US and moved towards China. We're seeing the same thing in the GCC, Saudi in particular, and how important China is to these economies. So it's not something I spend too much time thinking about every day, but Indian companies are setting up manufacturing there. We know that Japanese and Chinese companies are setting up manufacturing there, so we do pay attention to it. On the services side, on e-commerce, pharmaceuticals, we're seeing some wins, some losses on that front. But Latin America will become more and more important, and keeping an eye on the yuan as we head into next year, also very important.
Vikas, Pershad, always good to have you with us. Asian Equities Portfolio Manager at M&G Investments. Great to have you with us.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.